Can you guys hear us on YouTube? Can you guys hear us on YouTube? All right, Joe, let's get the meeting started. Oh, hold on, Joe, you're on mute.
Here we go. All right, I'm good.
Do I have you now?
Yeah, can you hear me okay?
I can hear you now, Joe.
Perfect. All right, Sunday night, June 7th. I had to look at my calendar. I forgot what day it was. Thanks everyone for joining. My name is Joe Fahmy. I'm here with Frank Zorrilla. How you doing tonight, Frank?
I'm doing well. Thank you, Joe.
Thanks for putting this together. I like to start with just a little bit of the process. I'll start with a little bit of mine and, maybe you can get into a little bit of yours, but just sort of a good thing. I'm going to share my screen here. And I'm going to pull up MarketSmith just to sort of a general process I think everybody should do is take a step back and look at where we are in the markets and look at the general trend, look at distribution days, look at if we're in an uptrend, downtrend, and so forth. And just pulling up a daily chart of the S&P 500, just the bigger picture is we're above the, let me pull out the pen here. We're above the red line, the 50-day moving average. We're above the black line, the 200-day moving average. We're seeing very little distribution. When I look at the big bars, I just see big bars of accumulation in the markets. So just overall, we've had a nice trend up and we consolidated through April and parts of May, and we're resuming higher. And like I say, the big institutions control the market. The trend is strong. So why mess with it? Will we see pullbacks and shakeouts along the way? Absolutely. But right now, we're in an uptrend. And I'm saying stick with it. So, Frank, I don't know if you want to add some of what you're seeing or what you kind of do on your, sort of your big picture views and so forth.
Right. I'm going to, let me just ask you that. Right. Look, Joe, the market is uptrending. We're up tremendously from the lows. The IWM is up 58% from the lows of March, which is a tremendous feat considering what's been happening. But yet we're still pretty much 11% below the 52-week high, or the 52-week high.
On the Russell, you mean?
On the Russell 2000.
Yeah.
Now, let me ask you this, Joe. We're above the 50-day moving average. We're trending higher. That's great. But what about for someone who's not in the market and he just missed this 30%, 35% move, and now he wants to get in? Just because we're above the 50-day moving average, does that mean that he can go all in right now?
Yeah, that's such a great question. And I mean, if you're in heavy cash, I wouldn't, again, it's not investment advice. I wouldn't go all in here, but my personal feeling is with this little distribution and the Fed on our side is you got to know your time frame. My feeling is 3 to 6 months and towards the end of the year, we could be higher based on a lot of the statistics and strength we're seeing. So you got to know your time frame. But let's say there are some stocks or you want to scale into the market to participate. It never has to be all or nothing. If you want to buy 100 shares of something, start with 25 if you have a longer term time frame with the especially on the indices, with the intention of maybe adding another 25 if we head lower. Right. But it's just so hard to jump in here. But what I will say is with the Fed on our side, interest rates incredibly low. They're not raising rates anytime soon because one, they want to make sure that the recovery from the coronavirus happens well globally. Two, we have an election coming up in November, so they're not going to mess with the uncertainty of the presidential election. And three, after the election is holiday shopping season, and the retailers have been decimated over the past few months, so they definitely don't want to mess with that. So my point is interest rates are going to stay low globally. There's going to be tons of liquidity provided into the system. And we're seeing very little distribution. So why fight the Fed? But would you go all in now? Absolutely not. But I mean, that backdrop and 5 or 6 trillion in money markets is probably what's going to help keep this thing afloat for a while.
All right. So in other words, you can probably go in a little bit here and be prepared to buy the dip. And when the dip comes, if we're still above the 50-day, not much distribution based on the way you see things, we're going to be okay.
Yeah, I mean, again, I love one of Stanley Druckenmiller. My favorite quote of his, or one of his so many great quotes, is he says, "One of my biggest strengths is my ability to change my mind quickly."
Right.
So the question you're asking, and that's what I love about what you do too, is that, we're flexible. We're not stubborn. We're not going to say, hey, we're only going up, we're only going down. You more than anyone has taught me that, hey, you got to realize, yeah, there's going to be some digestions along the way. And the point is, for now, that's what I'm seeing. Of course, the summer's coming up and there's other things. So, that's why you stay on top of this and you screen and you do this work on a regular basis and let the market guide you one way or the other.
Right. And guys on YouTube and also in the live Zoom meeting, if you have any questions, please put them on the chat. So that way we can make this a little bit more interesting, a little bit more interactive, and you can learn a little bit more. So the reason why I asked that question, Joe, is because there's a lot of people right now with that predicament that they were following the news, they were following the virus. Then they had a tremendous return. I mean, the market left them behind. And now they're saying, what am I going to do here? Should I go
Yeah.
all in? They're watching all these Robinhood traders step in and making a ton of money. And I'm going to tell you right now, Joe, you're going to have a ton of traders who are going to try to create scans or try to ride stocks like AAL, for 100% moves, thinking that this is a market environment that's going to last for an entire year. Okay. And I think that's a mistake a lot of people do, that they have one market environment and they do really well. And then when that market environment changes, they continue to do the same thing and it doesn't work out as well. And then they go into this circle of trying to perfect their strategy and looking for that secret sauce that doesn't exist.
That's a great point.
And
That's such a great point. Go ahead. Sorry.
and that's going to happen here. So I think it's important to people. Look, this market environment is a lot different.
Go ahead if you want to share your
Yeah,
screen.
let me
Go
share my
ahead.
screen. Right.
Yeah.
This market environment here, from this bottom to here, is a lot different from here to here.
Yeah.
So here, if you were buying individual names, maybe you were looking for a quick pop, right? Because the market wasn't giving you much. And right over here, things are acting a little bit better. You just want to make sure that you don't think that this over here is going to last forever.
Yeah, that's such a great point, because we are all humans and affected by recency bias. So in March, you think the market's never going back up again, and now people are thinking it's never going back down again. And that's why you need to study history and realize, like Peter Lynch said, in the last 100 years, there's 30 or 40 bull markets, 30 or 40 bear markets. Bear with me. I'm just whatever the numbers are. But my point is, he's trying to emphasize there are cycles. And especially for some of the newer traders, hey, if you made a fortune on the airlines or Hertz or something last week, God bless. But like Frank said, realize this isn't normal. And you're not going to, don't expect to, be making 100% a week on some ETFs and some stocks where it's a strong environment. Stay humble, make sure your entries are strong, do your work, but you can't expect to be just, swinging away. Now, I will say one thing. I started around 97, 98, and it was around that .com boom. And I had a lot of friends at the time. The Robinhood accounts of the day were the Ameritrade, E-Trade, Schwab. They all started with more online brokerage. And I had a lot of friends who started opening accounts, and you would think, okay, that's it. That's the top. It went on for 18 months. I'm talking 18 months of just what was the next, there weren't weekly calls. What are we going to buy? Cisco calls. Let's jump into, Microsoft. Let's jump into Dell. It's going to split every year. eBay, Yahoo, all these .coms were just beside. Those are the ones that are still around. I'm not even talking about the other ones that have just gone away, the pets.coms of the world. But my point is, this can go on for a while. But I think Frank's point is just study history and realize that this isn't going to go on forever. Take advantage, but be smart.
Right. More importantly, I mean, it's obvious within this uptrend that all we need to do to find ourselves in a winning trade is know how to click a mouse. Whether or not you're going to keep that money that you made in the last month, that's a completely different story. Now, once this market starts to go back and forth, then it's a mental game. How well can you execute? So you can make the money, but holding on to it and keeping it and growing that money, that's a completely different story. Now, when I look at the market, we have a market that's, look at the S&P 500. We got a rip higher, we got a rug pull, sideways action, and it's the same cycle over and over and over again. And what you want as a trader, you want your P&L, right? You can't avoid these cycles. You want your P&L to go through the same cycles: consolidation, rip higher, pullback, grind higher over and over again, just at higher levels. So you have to make sure that when you're showcasing your P&L now after the last 30 days, that you don't get too cocky and forget the fact that you're going to have to keep that money and hold on to it for a little bit longer than a cup of coffee. Now,
So I should delete my Reddit post with a snapshot of my
yeah, right. Right. The way I'm looking at the market right now, listen, I long term, I'm always a bull when it comes to the indices. I think here in the short term, uh, we've gone too far. But I could have said the
Yeah.
same thing, and I said the same thing right over here, and right over here, and right over
Yeah, no,
here.
I believe me.
Right.
A lot of people thought just, S&P 3,200 day,
Right.
nice round number, nice resistance. I know people who set off the lows, 2,700, I'm shorting the heck out of this market.
Right.
2,800, I'm shorting. 3,000, I mean, if you hated the market at 2,500, you're going to hate it even more at 3,000. And now we're close to 3,200. And I've been saying the same thing, but I think the key is that you have to adapt. I never believe in being a perma bull, and I never believe in being a perma bear. Why? Because there's sometimes the market's going to do well and we're going to be in an uptrend. Recognize that and take advantage of it. There are times when the market's going to correct, and recognize that. And why would you be a perma bull in all of March? I mean, you have to, reduce exposure and get defensive during that time. When things turn around, things set up, then you get a little bit more aggressive. But you have
Right.
to be able to shift those gears.
Right. And let me tell you what that means to me, by the way. Um, just because I think we're overextended doesn't mean that I'm out there shorting recklessly or shorting the indices. I am still taking individual trades as they come. Okay. On every single day. I own the indices, the SPY, the Qs, and the IWM as core holdings, but I'm still taking the individual trades as they come. Now, because I believe that we are overextended, I might reduce my size on each individual trades. The way I'm looking at it, Joe, is look, we're in a basketball game. It's the fourth quarter. We're blowing these guys out by 30 points. I'm taking out my starters. We're still playing,
Yeah.
but now I have my subs, and my subs is just smaller size.
So we're taking out you and you're putting in me in the game is what you're saying.
Right. So as a bull, I want to see consolidation. And for me, for example, if we consolidate here at 319.34, Friday's closing price, and we go sideways for 15 days, I believe that would be a much better risk reward trade at the 15 days of sideways action, even though we're at the same price than right here, because we can pull back to the 20-day, which is at roughly where are we, 20 at 298, and that's normal.
Yeah, in an uptrend, strong stocks and strong indexes pull back to the 20-day. If you pull up the NASDAQ, like the QQQ, it's happened or anything. I mean, look at it, pull back to the 20-day, what, 3 times?
Right.
So even if it's a quick short dip, but those dips are 6 to 8% down, and with the high beta, high growth names, they can correct twice that. So that's why Frank's sort of encouraging, you got to take some profits into the strength. Don't expect that you're just going to double things every day if you've been lucky to trade some of the highly shorted names. But, the bottom line is I agree. Like, this is Ryan Dietrich had a great stat that he just posted before I logged on. I think he said this is the S&P is up over 3% 3 weeks in a row. And it's only happened since World War II was September of 82. And that's right around when, 82 to when we started a really nice bull market. So you get a lot of these Marty Zweig thrust readings, basically this power off of the lows. and what the point of all these statistics are, it is saying 3, 6, especially 6 to 12 months from now, we're going to be higher. That's why I agree with Frank. Longer term, are we bullish? Absolutely. But in the short term, we could see some, consolidation, and that's why you need to define your own time frame and stick with your own plan.
Joe, let's get to this question here. With the rotation we have been seeing in the past 2 weeks, where XLI, XLE, XLF, and even XLRE closing above. All right, so basically XLI, XLE, XLF, all the stuff that's down at the bottom. Now they're participating. Is that a healthy market going forward for you, Joe? Or do you even look at that stuff?
Yeah, I do look at that stuff. I look at it as it's a healthy bull market, because that's what happens in bull markets is sector rotation. So a lot of the stuff I've been talking about since early April, software and medical products, biotech, semiconductors, a lot of them have gone on great runs. And then when they get a little bit extended from a proper buy point or a proper base, now the sector rotation comes in, because my theory is that in the old days, money managers used to go to cash and would get, let's say 10 or 15 years ago, would get 4, 5, 6% on their money. Now, because you can't get anything on their money, they're rotating into those ETFs that you mentioned, maybe some energy, maybe some financials, maybe some utilities. And to me, that's a sign of a healthy market where, okay, maybe growth is going through a little bit of a pullback, sideways movement, normal digestion, whatever you want to call it, and money's rotating into the beaten down value sectors or the opening up the economy sectors, like travel, like casinos, like some of the gaming stuff like that. So to me, that's a healthy sign when they're taking money out and rotating it, which is why personally, I think it's just very hard to fight this trend when you constantly see that sector rotation.
Right. There's another question here about Netflix. Netflix action a little weak for the RS. It showed during March.
Yeah, I mean, Netflix was holding up incredibly well. The weekly chart broke out of, is that a daily or weekly you got up?
I'm gonna get a weekly now. This is the
No,
weekly
that's fine.
now.
As long as you have a big daily chart, it's fine. You have the widest. That's perfect. I mean, look, it consolidated. Netflix, Amazon, Nvidia, big mega cap leaders. They all consolidated what, 2-3 years on the weekly roughly, and they broke out. I think you use, for longer term holders, use that 50-day or the 10-week on the weekly chart as a good guide. 50 days a good guide. I know what they're saying, that it was one of the first to come out in April and really did well ahead of their earnings. I mean, look at the pros and cons. Their earnings growth is still phenomenal. One of the cons against Netflix is the competition from Hulu and Disney Plus. And what I think is just stupid is that now that the country's opening back up, no one's ever going to hop on a Zoom call. No one's ever going to, oh, honey, cancel the Netflix subscription. Like, it's the dumbest thing ever. I think people are still, in fact, going to realize that, hey, I was using Netflix and I like these shows, or I'm not used to Amazon and maybe I'm going to continue to order on Amazon. And hey, I've done 10 Zoom calls this weekend. So
there's no one disconnecting Netflix, whatever it costs, $12, $11. It's just not happening.
That's sort of the country's opening back up. So let's kill all the stocks. Yeah. But I think Netflix is fine. I like it.
Looks fine.
Term.
I mean, the thing's been trading. Thing's been trading sideways for 2.5 years. It had a nice breakout, consolidating. The 50-day moving average, a 10-week right now, so trading at 415. Where is it? 415.41. If I was taking this trade on a weekly basis, right, giving myself a little bit more time, not even looking at the daily chart, I'm taking the trade through 428.71. Call it 429 would be my buy stop, with an initial stop right over here at 397. That would be my trade with Netflix. Now, you mentioned Disney.
Disney Plus, yeah. It ran into its 200-day. So, all right, so Disney's obviously a huge portion of their revenues are the theme parks globally, and they got hit because, I mean, obviously they were closed. Disney's a phenomenal company. Obviously, it's I'm not going to bet against Disney, but it took a hit because their earnings and sales took a hit. You still get a small dividend, 1.4% dividend. It's run into its 200-day, but these things that have taken this big of a hit, a mega cap stock like Disney, it's just going to take a little bit of time to recover. So I think that's kind of what your point was earlier. Like 225 billion market cap, and it just moved from 80 to 120. That's a big move for a mega cap stock. let it digest for a little bit, let it go sideways, and who knows, maybe if things come back quicker than we realize, this thing could shoot up. But right now, I think some of these names just need a breather.
Right. And I think it's important, guys, what your time frame is. The longer your time frame, the less the entry matters. The shorter your time frame, in my opinion, the more the entries matter. If you have a long-term time frame, then you can do random entries because you're going to hold on to the stock for a year to 2 years. But if you're looking for a short-term push, then entries do matter.
Yeah. Can you stress your point? I think it's a great point about, especially for people who work during the day and can't watch the markets, about having a wider stop to give stuff room. Because I think that's a great point that you make.
Right. Right. And it's not even because people work. The majority of people, of new traders, what do they want? They want to they want to be right 75% of the times, and they want every single trade to be a 5-to-1 trade. They're making five for every
I
dollar
think
they're
they want to
losing.
be right 100%.
Right. And that just doesn't happen, right? So most traders fall into two category. Either you're a high win ratio guy, but your risk reward, your dollar gain is pretty much the same or even, or you might be a 30% guy who's profitable 30% of the times, but you have a 3-to-1 ratio as far as winning is concerned. So there usually two type of stops. You got a tight stop and you got a wide stop. With a tight stop, you're going to be shaking out a lot. You're looking for short-term moves, and a lot of people can't seem to buy something and take a loss immediately. They're more comfortable taking that same loss 3 months down the road. It's been 3 months, that's it. But within a couple of days, they can't do it. So my suggestion for those people who have that issue is that you start with a wide stop. Someone's asking about Chewy. The way I look at Chewy, for me as a short-term trader, the way I buy stocks with a 4 to 5 day time frame, this is not my setup. If you can see here, the arrow, this is where I bought Chewy right over here, 4-8 at 34.20. It was down 5 days in a row. It had an update. I bought it through this high. Then I'm looking to sell on the way up. So this is what I'm looking for right over here. Here, I'm looking at a stock that's up 4 days in a row and it's trading sideways. It's about $3 away from the 10-day moving average. This is not my type of setup within my time frame, which is 4 to 5 days. If my time frame was 6 months, I'm going with it. With a
Yeah.
stop at the 50-day moving average.
Or you picked it off perfectly down there, or if you missed it down there, a secondary buy point could have been, I'm not saying because it happened, but like I said, strong stocks and strong markets hold their 20-day. A secondary buy point could have been the 20-day about 5-6 days ago. It wasn't super tight, but at least it consolidated around 40, and you might have used the 50-day as a quick stop. But
Right.
that's one thing that's such a great point. Your entry point is everything, and you got to buy off of some consolidations where if someone says, what do you think of this stock sticking straight up in the air? I like to talk about like a rubber band. You can stretch a rubber band and it can keep stretching. Eventually it's going to snap back in your face.
Right.
So you want to buy the compression, not the expansion.
Right. And I want to stress the time frame. Is this overall, is Chewy a bullish pattern? It's above the 50-day moving average, is trading at an all-time high. All that is bullish. All of it. But since my time frame is roughly 4 to 5 days, it's not for me based on my time frame. But if you have a longer term time frame, this is a bullish shot. There's nothing wrong with it. There's nothing wrong with it at all. You can buy it here if you like the story, but you will have to use a stop all the way down to the 50-day, which is roughly about 15%. And if you can handle that type of pullback, then go with it.
Most people say they can, but then when it happens, they can't.
No, if they say 15%, they really mean 5%.
Quick question for you. There's someone's asking if you do any hedging.
Hedging.
You want me to start? Or you want to take that one?
Right. So I own the SPY, the Qs, and the IWM as core holdings. And the only thing that changes is my allocation to those to the core holdings. So if we look at the average intra-year decline for the market is roughly 14-15% since 1980. So my allocation starts to increase once we get down to that 15% level. Okay, that's what it is. So I'm not increasing my SPY holdings on the way up. I am increasing on the way down. On the way up, I am decreasing when we get these huge rallies. I'm looking to buy them on the dip. Now, for the first time that I can actually remember, this is the first time that I've hedged a little bit the SPY, Qs, and IWM because again, I'm always going to hold on to a piece. So if I was at 45% as far as my allocation was concerned back in March, right now I'm at 15%. I'm not getting much lower from there. So I might want to hedge it a little bit and give up some upside. But that's because I own the SPY, the Qs, and IWM. As a short-term swing trader, I would never hedge by buying the SPY puts or the QQQs to hedge things that I'm holding for 4 to 5 days. And the fact of the matter is, like Joe mentioned before, what we're getting now is a rotation. So you're rotating and the indices continue to be propped up because we're going from software to energy to banks, back to software, back to growth. So the indices are not pulling back. And I had some great shorts this week. While the indices were still going up. So some individual names provided some good shorting opportunities, but not the indices. So no, I am not hedging my individual stock ideas with the market. That just hasn't worked.
Yeah, no, I mean, I kind of agree with that. Instead of hedging, I'm a fan of reducing the share size. So I talked about some of the growth names that I've been in. Let's say you have 100 shares, maybe you cut it down to 50. And I mean, so let me just say this. The basic question, whenever somebody asks me, and I'm sure it's the same way with you, Frank, what do you think of this stock? What do you think of XYZ? The reason they're asking is because they own it, usually because they have weekly calls or they have a huge position or they're just so deep in this position and they just want to know what you think. And I know that's why they're asking, because why else would you ask? I'm not going to ask you about something I don't own. So my whole thing is, I'm guessing you have a huge position. And they're like, yeah, right. I'm like, well, why not sell half? Especially if you have a nice gain, because reduce it to a sleep at night position, meaning if it goes higher, you still have some. And if it goes lower, you locked in some profits. Now, that's not advice. That's just general sort of, if you're stressed out about a position, or if you have a really, really nice gain and you're saying, what do I do? For example, I have 100 shares of a software name that just took off, made a nice 30% gain. Why not sell 50, keep a core position? If it goes higher, great. If it comes in, at least I still have some and I maybe could add to it. But that's what I would rather do rather than hedging. Now, some people might want to buy, put spreads or might want to write calls against it. There's a lot of different things you can do. Me personally, I like to keep it simple.
Right. And a couple of things, Joe, on that point. You can ask whoever you want about an individual stock and they'll give you their opinion. That doesn't mean that it's going to do exactly what that person said. Stocks go up and down. So what you need to do before you buy a stock is have a plan. Someone just asked me about MRO. I'm long at 542 and the stock is trading at 745. When should I sell? I said, sell some immediately. And hopefully your first, right. Hopefully your first sale is your worst sale. Diversify your sales. And what that means is you take some off on the way up. And maybe you put a stop at the 10-day moving average. If you like the company, put a stop on another 25% at the 20-day moving average. Diversify your selling strategies. And hopefully the first sale is the worst sale. If it's not, then you got some off at a higher price.
Yeah, no, I agree with that. I mean, there's nothing wrong with it. Just creates a little, I think you're basically saying it creates a little clarity. That's all. Just take a little bit off so you're not too stressed out, especially if you have a nice gain. But as always, know your time frame. And if you're asking someone, it's probably because you just want to hear what they want to hear. So I just tell them what they want to hear. But
Right.
I mean,
Right.
but you're eventually going to do what you want to do anyways. So make those decisions on your own, build that confidence so that it comes to the point where you don't feel that crutch to need to ask somebody or to look on social media for what people are doing, where you're making these decisions from a position of confidence, a position of strength, and a position of sticking to your own plan.
Right. All right. So if price is over the moving averages, you assume it is bullish, and I might keep going up tomorrow. No. Tomorrow is tomorrow. Anything can happen tomorrow. So the price, look, you can do something general and say if a stock is trading above the 50-day and the 200-day moving average, it's in an uptrend or it's bullish, right? That's just a general saying.
That's a general guide. That's
Right.
my general guide for markets and stocks if they're above those Paul Tudor Jones, I think, uses the 200 days. Some other people like myself use the 50-day, depending on your time frame. If the stocks and the averages are above that, for the most part, it's bullish. Yeah.
Right. What's going to happen tomorrow? No one knows. That's the issue. Look, when we get into a trade, we don't know the outcome of that trade. Okay. When I get into a trade, uh, I don't know what the outcome is going to be of that trade, whether I'm going to be right or wrong. The way I look at it is very simply. Let's say, for example, I look at a trade, whatever it is, and I'm looking at the setup, and I'm going to ask myself, would I take this setup for the next 1,000 trades? And if the answer is yes, then I'm taking it. Now, if I take that same exact setup for the next 1,000 trades, and I've already have a series of trades, and I see that with that particular setup, I've been right 60% of the times, I'm still not going to know the sequence going forward of the wins and losses. It's that
Yeah.
simple.
Yeah.
So the key is that if you look at a setup, this is my type of setup, whatever XYZ, I'm going to take it for the next 1,000 trades. I don't know if this was going to be a winner and the next one's going to be a loser, and or vice versa. You just take it, just like you're playing basketball. You got a mid-range game. You have an open shot. That is the right shot. You take that shot. That's it. Whether it goes in or not, it's irrelevant. You're open within your range. You take the shot.
That's a great analogy. Let's see. Someone's asking, Frank, what program are you using and it's available to buy? Would you recommend it for a newbie?
Well, it depends. It depends. Look, when you're starting out, you have to be careful how much money you're spending in software. You just have to be. So I don't know if you have a decent account and you can afford it, then do it. I
Yeah, no,
do.
that's a great point. If a newbie has, yeah, I mean, smaller account versus a big account. Yeah, I mean, it's
Right. This is Word
go
and
ahead. Go ahead.
Word and TC 2000. TC 2000. Just Google that right over here. TC 2000. So that's all relative. It all depends. I mean,
Yeah, and I use Market Smith. I mean, we both use great products that we like and use, and I also use eSignal for real-time quotes, all this stuff. But I agree with Frank. If you're starting off, there's a lot of great free resources. You don't need to be spending, and I mean, we love these products, but we're the first ones to tell you don't need to be spending tons of money. Something like FinViz,
right.
FINVIZ, I think that's great for just free charting, free screening, and you get a lot of parameters in there, and you get a bunch of charts, and you learn how to read charts. And you don't need to be, it's not how much money you're spending on the software programs. It's just more learn. I think get some of the chart books just to learn how to read charts as well. I think that's something for $10, $15 paperback. You can learn a lot of things on Jesse Livermore, O'Neill, Darvis. All these books are great to read.
Right. They're asking here about Whale Rock. What do you think? What's your opinion on Whale Rock Capital?
I've heard some stuff about them. I don't know enough about their position, so I'm going to pass on that. I know I've heard good things, but I'd have to look at their positions. As far as someone saying Koifin is great and free, that is true as well. Werewalk, I don't know enough about them, so it's not.
Yeah,
It's not a fun.
they're actually look, they're decent. They're decent. Again, if you're looking to follow hedge funds, that's I don't know, that's not easy.
Well, unfortunately, a lot of the data is delayed because with the 13F filings, it's 45 days after the end of the quarter. So if you have January 1 through March 31st, and they don't have to report that till 15 days after the quarter. So what is that, May 15th?
Right.
They could be out of the position between April 1st and May 15th, or you don't know if they bought it on January 1 or March 31st. So yes, it's good enough data, but it's not real time. So it's really hard to go by that.
Right. So look, if you're able, look, this is where
Oh, you pulled up their positions?
yeah, Whale Rock Capital, Amazon, Microsoft, Tesla, Shop, all
Yeah, some great growth names in
all
there. Yeah.
growth names, right? So
Great growth names.
if you wanted to follow a hedge fund, then you're gonna have to file. I mean, you're gonna have to follow when they file a 13D, and that'll be a new position. And hopefully that new position is, it's gonna be big enough where they have to file a 13D, and hopefully it's big enough where it actually makes a difference in their portfolio. And then you can start pretty much right around at the same time. So if you like Alex, whatever this guy is from Whale Rock Capital, Just wait until he files a 13D in the company and see if it's big enough where it actually is making a difference in his portfolio. Right now, his top 10 buys are worth 764, roughly about 40 to 45%. So he normally takes around a 4 to 5% position.
Yeah, when I look at these guys, one thing I like to do, especially, is look at biotech because they have the resources I don't have. So I like to look at some of the top biotech funds to see what their holdings are. But I do like to look at position size. I like to look at how long they've held the position. I'd like to see if they're, churning, and just not churning in a bad way. I just mean, like just flipping positions, or if they have some core holdings.
Joe, it's only churning when you lose money.
That's a good point. It's
Right.
only a bad idea when you lose money too.
Right. So here is, change rate over the last quarter. ZM is new, Micron is new, Docu is new, Intel is new. All these things are new. This is, by the way, hedgemind.com, their premium products. So if you're into, listen, we're mentioning a lot of different companies, Joe. We should get some type of
I know.
advertisement money from this. We mentioned Finviz, TC2000, now HedgeMind. So if you're
know.
into 13Ds and following hedge funds, this is a great one. Okay.
Yeah. What else we got here for questions? In the rotation to laggard industries and stocks, what scans do you run to generate ideas? I can take that one quickly, and then you can touch on it as well. I'm a growth manager, and I remember when I talk about knowing your time frame and knowing your plan. I have a plan that I stick to. So for the most part, I'm looking for growth stocks. So I'm not running scans to look for the airlines and the travel and the gaming sectors and the financials. If they show up on some of my growth and relative strength screens, that I'll be interested. But I'm not running specific scans for lagging stocks. Because I'm not trying to keep up, like Frank said, the sector rotation, one day this, next day that. It's impossible to keep up with it. So I'd rather stick to what I know. But I will say this, if you want some exposure to that, why not buy an ETF? Because at least that gives you broad exposure to the whole sector.
Right. And again, it's all about time frame. So on the flip side, Joe, since my time frame is a little bit shorter on my individual trades, some of those stocks are going to come up on my scans.
Yes, they will. Absolutely.
Right.
And you can nail those explosive moves. And that's,
and there's nothing,
right.
Again, what you need to find out is what is your time frame. And when I'm talking about time frame, we all have a desired time frame. My desired time frame is to buy 2 stocks that go up 1,000% in a matter of 6 months. Right. My actual time frame is completely different. So you can't say my time frame is 6 months and over the last 2 years you haven't held a stock for longer than 10 days. So you have to understand what your time frame is, and then once you figure out what that time frame is, then you go out there and you start to study what works best within that time frame.
That's a great point. I think I have some questions on a couple. Let me pull up MarketSmith, a couple of charts here. Some people want me to look at. So give me 1 second. Let me pull up MarketSmith. Someone asked me as a growth manager, my views on CLOU sector, names like Twilio and Datadog. Look, I love software longer term. I've talked about the cloud names for a long time. I think the cloud is, I don't want to say it's in infancy stages, but keep in mind things like big governments and big school programs, they take forever to make decisions. So, I saw one of the companies, the Air Force, just signed up with them to join their cloud program. So there's still companies and legacy systems moving to the cloud in so many different areas that I still think this is a great growth area. Personally, depending on your time frame, as Frank says, shorter term, some of these things are a little bit stretched. The way I look at this, CLOU is, it looks like a cloud computing ETF or index, where 18 is sort of the buy point out of the base. It's run a little bit, just probably needs to digest but something like they asked about Twilio and Datadog. I mean, yes, it's pretty damn impressive when a 28 billion market cap company goes from 100 to 180 and just holds up here in a range. That's pretty damn impressive. So for people who are nimble and people who, have a little higher risk tolerance, you could maybe trade around that range. But me personally, I'd wait for a little bit of a digestion, but it's pretty impressive when these types of stocks like Datadog, the ones that they're asking are great companies with explosive growth. It's pretty impressive when they make these huge moves and run up here. But so that tells you how the strength in the sector, but it also depends on time frame. Hopefully, if you're in these from a lower level and you have a longer term time frame, you can sit through these consolidations. But I still like these longer term, but they need a little bit of a breather here.
Right. So in other words, regardless of the numbers, that they're great, these stocks will go up and down, not up or down.
Yes.
Right.
Let's see. Any other questions? Do you have any questions in the chat? I didn't check the chat if there was any there.
No.
No.
No. But here, any recommendations on picking a trading strategy? How did you back test the strategy, and how many do you have in your tool belt at one time? How do you pick a trading strategy?
I just want to make money.
Right.
That's my strategy. Let's pick stocks that go up and make money. Look, I think the main two strategies are growth and value. And I just think it depends on your personality. And I think it depends on your time frame. I think it depends on your risk tolerance. And it depends on if you're working during the day and you can watch things. I think you need to be honest with yourself and define what you are. Are you a trader? Are you an investor? Do you have a high risk tolerance? Are you 30 years old? Are you 70 years old? You got to answer all of these questions and know what you can deal with. As far as some people, all they do is day trade. I have nothing against them. I can't do that because I'm not good enough to know when I kind of have a feel a stock might be going soon, but I can't pick the exact day. So I want to give it a little bit of room. Some other people say, you know what? I don't want to day trade. I want to hold something for 3 months, 6 months, or a year. But the whole point is those people have defined their time frame and their philosophy and what works for their personality. So that question really is impossible to answer because the answer is it just depends.
Right. It's all relative and you need clarity. So if you're working during the day, you can't day trade. If you can't, if you have a hard time taking tight stops, losses immediately, then you need a wider stop, longer time frames. If for some reason you don't like taking 20% losses, then you have an issue. You gotta find clarity because either you're gonna have a tight stop or a wide stop. So you have to be comfortable with decent sized pullbacks, or you have to be comfortable taking stops immediately. So just find solutions based on what it is that is going on in your life.
Exactly. Like I pull up something like, I think of dividend names, Verizon, AT&T. I pulled up Verizon, VZ. So this is what I mean by value names. They've basically earned $4, give or take for the last several years. The great company. They're not going out of business, of course, but are you going to get a great dividend? Absolutely. 4.3%. You're not going to get that in the savings bank, but are you going to get major capital appreciation? For the most part, the stock has been great company, right around $50 to $60 for a long time. So some people who are retired and they'd rather get 3 or 4% in the bank, but they can't. And people I know, they're saying, hey, you know what? I got to own these stocks like the AT&T and Verizons of the world. AT&T's been $30 to $40 for a long time. Same thing. You're getting a 6.3% yield. So that works based on your age and based on your time frame.
They're probably buying weekly calls to hedge themselves on some pen or some national gaming. Look, here's a great question. Could you share your steps of your post-trade analysis? How often do you do it? Each quarter, each month, each week?
That's a great That's a great question. I kind of have been doing it for so long that I kind of know my numbers, but I'm still always doing post analysis. I would say
After losing streaks.
I honestly, it's after losing streaks because when things are going great, I'm out in the sun having fun.
Right.
But no, that's such a great question. I would at least do it every 6 months or so. I know Jesse Livermore used to go into the safe and every January and take some time off and actually ask the banker to feel the cash. He would take cash out and sit there and go through his trading log because he wanted to make sure it was real and not just a paper profit and not just a number on paper. So he would do his once a year. I think it's at least you do it every 6 months or so, just to reevaluate. But I kind of know my numbers after doing this 20 years. So I kind of have a feel for what they are. How I use those numbers really quick is if I'm running a little bit hotter than my average, I know it's too good of a market to take in some profits. And if I'm running below my average, then I know it's not a good market, and I'll actually, cut the position size.
Right. And I think it's all look, the post analysis is great, right? But I think one of the issues that people have is that you're grading a trade based on hindsight, what happened afterwards. So most individuals, what happens is if they sell something and it goes down, they're happy. If they sell something and it goes up, they're depressed. Right. So then they want to change their exit strategy. The way I do the way I grade a trade, you have to grade it into steps. For me, based on my time frame, number one, did I put the order in? That's one, right? That's a check mark. Did the stock move immediately after I bought the stock? Yes, another check mark. Was I able to hold on to that to the stock for the 3 to 4 day burst? Yes. Did I sell some on the way up? Yes. And finally, did my selling create any value? Right? Because what happens is that people are looking for trades. Oh, I made 30% on this one, but it went up another 20%. That's a bad exit. Oh, this one went down 15% after I sold it. That's a good exit. So so when you do post analysis, make sure that you're grading in steps, not
and
just based
and
on what
over
happened
a
afterwards.
and over a series of trades, not
Right.
5 or 10 trades
Right. You
or
can't,
one
right.
trade. You're going to
Right. Because
torture yourself.
what ends up happening is that people are looking at one trade. Oh, this happened. I got stopped out of this trade and it went up. And then they want to change the entire strategy based on one trade. It's got to be 20, 25, 30 trades before you even consider making a change. And once you make that change, it's got to be slowly but surely.
Yeah, I mean, there's also the problem with the stock market is you always find out after you get out of the trade what happens, win or lose. So if you make that 20%, you say, all right, I'll take that gain, and it goes up another 20, just be happy you made money and shut up. I mean, like, you can't torture yourself. I can't even tell you the number of times I've been stopped out on the dead lows, near the dead lows. The stock's down 10%. I stop myself out, turns around, not only turns around that day and goes higher. That's part of the game. I have to stick to my discipline. So if
And it
I
goes back to
sat
clarity.
yeah, if I sat there and lamented and thought and cried about it you're going to torture yourself. And that's part of the mental toughness. The more you do this, you have to callous your mind. You have to have confidence in what you're doing. And I accept I'm going to get stopped out of stocks that might turn around. I've also got stopped out of stocks that have never shown up on my screens again. I can remember, trading WorldCom or even Molycorp when the rare earth stocks, I got stopped out at 77. I went and looked at it 2 years later. They're out of business. You know what I mean? So
Right.
sometimes you get stopped out. Don't just remember the ones you get stopped out of that turn around. Sometimes you get stopped out. They go much, much lower. Keep those in mind so you don't
Right.
mentally torture yourself.
You can't, number one, you can't cherry pick these things, just going off of one trade and then just forget about the other one. And number two, make sure that you understand what market cycle you're in. Every single market cycle is different. We might have a market cycle that's giving you 10 to 15% returns in each stock in a matter of a couple of days. And then you might have another one that's only giving you, 5%. So understand also the different market environments and different market cycles.
Yeah, Frank, there's a question. I had a good success with your 3 down day scan. Can you share your thoughts on exit strategies? Example, ENDP. I usually take some profits as the stock gaps up. How do you trail stop loss after a gap up?
Right, right. So the down 3 day scan, that's a structural scan. That's just the way the market trades in the short term. I think what matters to me the most is momentum and mean reversion. Uh, so ENDP.
Oh, go ahead and share your screen if you want to pull
Oh,
that up. Yeah,
okay,
sorry.
okay.
I forget that sometimes.
Right. So how do you sell? You sell on the way up, right? And so if you know my down 3 days in a row strategy, if you know that strategy, you know exactly how it works. So number one, you're selling on the way up. Number two, your initial stop was right over here at this low on 6-2. The following day, the stop was raised to this low. The following day to this low, and then finally the stop right now goes from 409. So hopefully by now you probably bought the stock at 398. The stock went up 15%. Maybe you were able to take a profit at at plus 10% for a piece. But more importantly, your initial stop went from 358 to 409 if you're following that strategy the way I work that strategy. So you're good. Now, the fact that this stock only gave you 15%, you know, maybe you want them more, but that's what it's given you so far. So you take what the market gives you.
And where can they find this scan? What's the
No, that's
zortrades.com?
no, that's private. Yeah, yeah.
That's on your in your room.
Right. Yeah.
Um, someone asked about, this is a good question about your favorite all-time hedge fund manager. There's so many great ones. I can think of two off the top of my head where I just want to say Paul Tudor Jones, and the main reason is consistency, because our goal in this game is consistency. I heard a podcast once. They asked the guy, how do you define excellence? He said one word: consistency. That is our goal. Michael Jordan is not the best basketball player ever because he scored 30 points in one game in his career. It's because he averaged 30 points a game over a 15 or 20-year career.
Right.
And Paul Tudor Jones, being the key word, consistently profitable for 20 something years, being profitable and not having a down year, whatever his streak was or has been. I forget, I lost track. 23, 27 years of being up every single year. Unbelievable.
Right. And that's what we spoke earlier when we first started here, that anyone can find themselves in a winning trade, is being consistent. That's the key. Okay.
Yeah.
Joe, you and I can, we can both take half court shots and you can make one, I can miss one. That doesn't make you a better shooter than me. Right. It's the
Maybe.
consistency, right? It's the consistency of making 50 out of 70, 50 out of 60 on a consistent basis.
If we're
Anyone
playing
can
for
make
if we're
one
playing
shot.
for lunch, I'm gonna make it.
Right. Right.
No, sorry, I cut you off. You were saying the
No,
consistency.
no, but it's right. It's keeping the money. It's doing it on a
Yeah.
consistent basis, not just one trade.
Yeah. And the other one just says is just my own personal with David Tepper. It's because it's been very difficult for hedge fund managers, let's say over the past 10 years. As we know, a lot of the returns have struggled. What I respect about him tremendously is not only putting together whatever stretch he had, 5 or 6 years of 30, 35%, he did it on 10, 15, 20 billion dollars. That is just amazing. Why? Besides the fact it's amazing doing it on $10,000, it's amazing because of liquidity, where all of his other peers managing 5 to 20 billion dollars, if they do single digits, are screaming from the rooftops. This guy did it, consistently and that's a great, you don't need a 30-year career. You do that for 5 or 6 years. Not to say he didn't have a great long-term career. I'm just saying he had a nice, amazing stretch in a period where a lot of hedge fund managers struggle. I think he's one of the most mentally sound, managers out there.
Right.
And that's part of what that's what I think. I think personally, individual traders have a huge advantage because I have a friend of mine works at a big mutual fund. They have to have a meeting on Monday mornings and then decide, and it goes through a process. Do we want to buy the stock? And then blah, 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 and a committee, and it takes forever. You as an individual trader, you can go in Monday, you like something, you can buy it on your own. You have no one to answer to. Number two is, if you're a Fidelity Magellan fund managing, I forget what they manage now, 70, 80 billion, whatever the number is, you're limited to your universe of stocks. I don't even need to look at their stocks. And I know their top holdings are Apple, Amazon, ExxonMobil. Just take the all top market cap companies. As an individual trader, you have the luxury of, you can trade smaller and mid cap names that some of these big funds that are trying to buy hundreds of thousands, if not millions of shares. If you're looking to buy a few hundred shares, you can do that on your own. As an individual, you can be much more nimble with a larger universe of stocks as an individual trader.
And you can sell them immediately as well.
Exactly. Someone's asking, Frank, can you explain the daily process routine of your 5-day watch list, how you follow up on potential trades, price alerts, how do you track and make follow-up for you? I know you talked about on TC 2000, you keep a rolling list.
Yeah, I'd much rather, Mark, I'd much rather you go to frankzorrilla.com and on the search box, do daily process. There's a video there. And I show you exactly what I do on a consistent basis. But, just to make it extremely brief, I am going through scans. As I'm going through scans, I create a watch list. Let's just pull this up. duplicate. I create a watch list. Then I put alerts at the previous day highs, and either the stock goes through that high or it doesn't. If it goes through that high, I have an interest. I want to buy it. The rolling 5 day watch list, I keep it here, and it tells me just very simply, how are things doing? How are these stocks performing? Are they continuing to go up? Are they only giving me a few percentage gains? Are they stopping me out quickly? So that's how I look at the health of the market for my swing strategy, is not by looking at the SPY, every daily candle, but by looking how my rolling 5 day watch list is doing.
Great stuff. Someone's asking me if my style is more position or swing trading. How do you handle when you see a bunch of your stops are going to be hit at the open? That's just a case by case basis. It's a great question. I kind of like what Scott O'Neill talks about, having your A stocks, your B stocks. I think sort of your Amazons and Microsofts and Apples are your A stocks, and Nvidias, these quality high liquid growth leaders that I think you can be much more patient, play them for bigger moves, not necessarily trade around them. I know Jim Cramer said forever, don't trade Apple, hold Apple. One, I think that's been amazing advice. And two, I think you can replace Apple with about 10 or 15 other stocks there. Don't trade them, just hold them. They're going to do well if we're going to continue in a bull market. With the B stocks, I tend to swing trade them, and I try to shoot for a few days to a few weeks to try to get those moves that, Frank and I have very similar eyes for charts. It might be different time frames, but we're still looking for the same concept, is great names coming out of consolidations and trying to get that explosive move, whether it's a 5 to 10% move or sometimes a 10 to 20% move, depending on the base that it's coming out of.
Right. And and it's also important here, that before you put on the trade, you predefine your risk. And by predefining your risk, what's supposed to happen is you're supposed to accept that it might be a losing trade. So just saying, hey, this is my stop, and not actually making that stop actionable when it gets there is an issue. You have to predefine your risk, and you have to make sure that there's no conflicting whatever energy on that stop loss. So if it gets there, you take it off. And if you have to buy it back because it's set up again or it turned out to be a shakeout, you buy it back.
Yeah,
Especially now when commissions are
such
zero.
such a great point. And I really want to emphasize that is something psychologically you're great at automatically doing that like a machine. A lot of people have trouble with that. They don't want to
Right.
be wrong. You talk about they're shooting for 75%. They're not buying a trade with the thought that they're going to be wrong.
Right.
And Paul Tudor Jones, I know he says something about, I just assume every morning all my positions suck. When I relook at them, I'm going to be wrong and I reset. I mean, I know it does not meant that literally, but you have to accept you're going to be wrong. And there's been some companies I absolutely love, and I buy them and I say, oh my God, this thing's going to be a triple. And then I get stopped out 3 days later. So because the market proved me wrong. And I don't have an ego. I don't care. I don't care if I tweeted it. I don't care if I told my neighbor this is going to be a double, blah. I don't care. I don't care. I have to stick to my discipline, and I have to accept you're going to be wrong probably more than half the time.
But what happens if it sets up again, Joe?
Then I'll buy it again. I
Right.
have no problem. I have no problem buying it again. And I have no problem buying it again at a higher price. And a lot of people psychologically, well, I just sold it at 40, it's at 50, or it's at 45, or maybe sets up later and you missed it. It sets up at 70. You got to get over that. You got to get over that. I mean, you could have traded Microsoft and Cisco in the 90s. They went up, what, 30,000%? What, because you missed the first move in 1991, you're never going to touch it again? I mean, come on. Some of these companies are going through growth stages for a long period of time and have had tremendous growth. And you have to be okay with being wrong. You have to be okay with stopping yourself out. You have to be okay with buying it back when it sets up. And you have to be okay with possibly buying it back at a higher price.
Right.
What are you taking a look at? You going through some names, or?
I'm just going through some chats.
You're doing your screening while I'm talking.
Screening, yeah.
Yeah, sorry to keep you, Frank. He's going through his screens while I'm talking. That's funny. What else we have? We have a couple other questions. We can wrap this up. It's been about an hour, but we'll take.
Yeah.
Well, I'm happy to take some more questions, but It sounds like we've got to most of them.
Let's give them a minute for some other questions. Risk of holding on to FNGU for 5 years.
I don't know what that is.
Yeah, that's like an ETN, a 3 times ETN.
Is
No
that
good.
the 3 times FANG index?
Yeah, it's no good. And the reason why is because number one,
Fang you sounds like a swear.
right? And the reason why is this holds, I guess, the FANG names, right? And the problem is that timing is everything.
Stay away from the 3-time leverage product unless it's a short-term trade.
Let me tell you. So here's the reason why. So timing is right. Timing is everything. Here, we all know that Netflix, Amazon, Google, they're up here by the highs, right? The QQQs, the top 5 names. This is all the way down here. And what happens typically, if you take a look at the QQQs.
Pull up QQQ versus TQQQ.
Right. Look
at that difference.
And
that's because they screw you on the 3 times and rebalance them every day. And it's a derivative of a derivative, of derivative. And there's all the small print, what's in it. You're going to get screwed if you're trading this. Go ahead.
Usually only matters, Joe, right over here when you have a huge correction from the bottom, right? When you have a nice trending market, that works. But over here, you're done.
Yeah.
You are done. But if you bought it here at the bottom, so here from the bottom, it's up roughly 177%, and the Qs from the bottom is up 45%. So we're good there, right? But if you held it for the long term and you were able and you caught this little this market action right over here, then you're screwed.
Yeah, I'm okay with the 3 times if you are nimble, if you're a day trader, if it's short term, and you can make decisions. If you're looking these for longer term holds, they're an eroding asset. So I'm not a fan of them, and I wouldn't recommend them at all. Plus, they have those like the XIV, which is a sore spot for a lot of people. They have that small print, like, oh, we can blow up any day, and sorry, it's in the small print. You're gonna get screwed. I can't see that happening with the major index ETFs, but with some of the other structured VIX products, volatility, some of these 3-time smaller, sector products, I'm not a fan unless you're nimble and unless you have, the ability to trade them short term.
All right, let's take these last 2 here. Frank, I think you often enter a buy stop. So if you see a good potential trade, all the trades that make my list are good potential trades. What the outcomes are going to be of those trades, it's unknown. So they're all good potential trades. And like I said before, when the stock hits my list, well, I'm looking to buy a trade for that 4 to 5 day time frame. What I'm saying is that I would take that same trade 1,000 times, right? If I'm able to take that trade 1,000 times and I take it, that's a good potential trade. Whether it works or not, it's a different story. We don't know the sequence of wins and losses. So do you place some order? Are you always in front of your computer when you take a bit? Look, sometimes I am, sometimes I'm not. I put buy stop orders. Okay. I put buy stop orders. If it goes through, I'm in. If it doesn't go through, I'm out. I'm not in. Very simply. I'm not looking at intraday charts. I'm not looking at any volume. Either it goes through the high or it doesn't, and that's basically it. The only time that I'm going to run through a problem is at the open. If at the open you have some of these large cap companies that maybe have a $2 spread, I can't take that. Maybe you have a stock that maybe like BNTX that only traded 6,000 shares in the first 2 minutes and it triggered. I can't take that. So those are the issues that I might come across with some of my trades. If you're home and looking to put buy stop orders and you're busy working and you can watch, my suggestion is you put buy stop limit orders. You put buy stop limit orders. Let's say, for example, the buy stop is 2020. Don't be cheap. Don't be penny wise, dollar foolish. Don't go 2021 as your limit. Go 2040, because if it's going to go, it's going to go. So you want to get in there. You want to buy it. You can also put a time stop, which means where you can start it at 9:45. So if you don't want the open the first 15 minutes, you put your buy stop limit order and have the order start at 9:45, at 9:37, 9:32, whatever time you want.
No, that's good stuff. That's good stuff. Anything else, or are we good? Or
hey, Joe, thoughts on AMD? Fundamentals are great, but RS line is going the wrong way, and it's lagged the rally so far, even though it held up well during the sell-off.
That's a great question. Me personally, I own full disclosure. I own Nvidia. I think it's the leader in the chip space. I love the story. I think AMD is great. I know what they're saying. They're saying, hey, it came back and recovered well, off of the sell off, and then it's just this is the RS line, the relative strength line has been declining. Look, the positives. It's a great story. It's holding its 50-day. It's right there right now. One of the negatives, I will say, the SMH, the ETF for the one of the semiconductors ETFs is at a new high. Some of the other stocks, KLAC and Skyworks and Corvo, and some of these, so many, there's a million semiconductors that are doing a little bit better. Look, I love the sector. I love the space. I don't own it. I think there's, better names, but I would just say, you have a good sort of idea over the next week or two around its 50-day, if it's going to hold this level. And that's something I would watch. So I don't know if that helps or not.
So
But
there's the trade. There's a trade. The 50-day moving average. There's a trade. You like it here. You like the story. You can get involved at a level that makes you feel comfortable and use the 50-day as your stop. Here's another question. Do you use Zach's research? I don't use Zach's research, and I don't think Joe does either.
no.
But right, Joe uses Marcus Smith. If Marcus Smith is a little too steep right now, Zach's is not a bad website.
Okay.
You know,
Yeah. I don't know enough about them, but I mean, I know there's some great products out there. So, but, hey, Frank, I appreciate this. Thanks for the, setting this up and for the opportunity. I think it's all the questions. We got to most of them. I mean, guys, thanks for, tuning in. You know how to reach us, at Frank's site, frankzorrilla.com, joefami.com. If you have any questions, our emails are there. We're very accessible on Twitter. That doesn't mean I'm going to respond to you on Twitter, but you can tweet to me. I probably have you on mute, or I probably have you blocked, but that's a whole other story. Anyway, but seriously, we appreciate you guys hanging in and for all the awesome questions. We hope to be doing this more regularly, just to kind of take questions and so forth. Frank, I don't know if you want to close it out or
that's it. We're done. It's
we're
8:36.
good.
To
All
go.
right.
There's no sports on, so I'll
I
come down
know.
the street.
As soon as sports is done, you'll never see our faces. As soon as sports starts up. So, thanks again, guys, and good luck trading this week.
All right. Treat him well.